So as expected, the Bank of England has once again increased the base rate of interest. And this has a big impact on your savings and on your borrowing. So we'll come back to that later on, what that might mean for those things, your mortgage, your savings accounts, credit cards, all that kind of stuff. But first of all, let's talk about this increase. This is the 10th consecutive increase. So this is the 10th video I've done on this in the last sort of 13, 14 months. They meet every single 6 weeks, more or less, to gauge, are they going to increase the rate? Are they going to keep it as it is? Are they going to drop it? And the most recent one, the one that's happened today, the increase is to 4%. It was 3.5%. It's now at 4%. This is the highest the rate has been in 14 years. In fact, we're not too far off the rate where it was in that 2008 sort of time, 2009. So we are, again, getting higher and higher and higher and higher. For most of us, in the last sort of 14, 15 years, we won't have seen anything like this. Obviously, we have been getting used to it over the last year. So 0.5 percentage point increase. Now, when the Bank of England meets to discuss this, there are 9 of them, and how they vote on this kind of gives you an indication of how confident they are this is the right decision. As the majority rules, this is 7 of the committee voted for this increase. 2 wanted to keep it as it was. So this is kind of an indication that most people are thinking this is the thing that needs to be done. This is the increase we need. And the reason they're doing this, the reason they want to increase the interest rate is because they think this is going to help tackle inflation. Now, you guys know, watch me regularly, I'm not an economist. I don't talk about those sort of things in a huge amount of detail, but the basics of this is the idea that if inflation, how much prices are going up, kind of makes it difficult for us to spend money, expensive for us to spend. They want to encourage us to save instead. And if interest rates are more attractive, that means that we will put more in savings, and that means that there is a demand for prices to come down, because if people aren't spending the money, they need to lower prices to get us to spend. That's ultimately where they're going. So these base rate increases that we've seen have largely been to try and combat inflation. Now, the current inflation rate is 10.5%. The Bank of England said 6 weeks ago they thought that it had peaked in November at 11.1%, and they're staying the same. So they think that inflation is going to continue to come down. Maybe by the end of 2023, inflation could be around 4%. And this doesn't mean prices are going to get cheaper. Things which have obviously shot up in the supermarket or anywhere you go, things are more expensive. They're still going to be higher than they are now because prices will continue, but they continue to increase at a lower rate. It's a weird thing about inflation right now is that so many other things going on in the world, whether it's the pandemic, whether it's what's been going on in the Ukraine and other kind of things, that has kind of meant it's not working in a normal way. And there are people saying that the base rate increases aren't going to sort of do this. But ultimately what they're saying is inflation has peaked. It will start to drop down. And as a consequence, the interest rate, the base rate that they've got right now, they still think it may increase further after this increase today. They're looking at maybe 4.5% by the summer of this year, by the middle of this year. When that happens, could that be the next meeting in March in 6 weeks' time? Could that be another 0.5 percentage point added on to bring us to 4.5%? Or could it be a quarter and then another quarter? Who knows? We don't know. It might not even happen. It might be higher, it might be lower. They're currently looking at maybe going to 4.5% by the middle of this year. And then they're looking at, in the next sort of 2 or 3 years, that it could sort of start to drop down. Maybe in 3 years' time, be around 3.25%. So this is kind of really the first time in these minutes where they're talking about, rather than rates keep going up and up and up, they're talking about we're almost there. We might be there. You never know what could happen. It might be we don't go any more than this. We might go a little bit more, but then stay for a while and then get down to, say, in 3 years, start us coming down to this idea of around 3.25% by then. It doesn't say whether they imagine that's going to be, how gradually that will happen, when that will kick in, but it gives you an idea as well, which I think is quite interesting, that they're not talking about us getting back to where we were of 0.75, 0.5, 0.1 over the last decade and a bit, after the financial crash, after Brexit, after the pandemic, all those increases that brought them down to consecutive record lows. We're not looking at maybe going back there, at least not anytime soon. So when you are thinking forward on these things, thinking about where things might go, we aren't likely to see, both good and bad ways, those, in a good way, we won't be seeing those really, really, really low savings rates, but also we won't be seeing those really, really low mortgage rates and things like that, at least not in the next sort of 3-4 years or so. So that's what's been decided. That's what happened in the meeting. Obviously, the next one will take place in 6 weeks. So I'll do another video letting you know what is happening there. But let's move on now. Let's talk about what this means for your money, what this means for you right now. And let's kick off with savings. I have covered this in my savings updates, which come out every single month, but it's worth going over it again because this impact is increased today. You might think, fantastic, if the base rate has gone on, that's gone up to 4%, then surely my savings accounts, because remember, the banks, the normal banks on the high street, wherever they might be, they are effectively borrowing money from the Bank of England. That's how it informs the rate. Think, fantastic, if that's gone up, then my savings accounts are all going to jump up by this amount as well. So I'm going to be earning more money. Sadly, that's not the case. For a start, many of them don't pass on any of this increase. So just because you've got money in a bank, don't just assume that you're getting the best possible rate. Have a look around and see what you can get out there. Now, there may well be, by the time this video's gone out this afternoon, you might find tonight, tomorrow, next week, some banks have responded to this and they may well have pushed their rates up a bit. But I think it's unlikely it's going to be the full whack. The other increases we've seen over the last year, interest rates are not suddenly 3.9% better than they would have been in December of 2021. They've gone up bit by bit from some providers here or there. And here, what I'm really talking about here mainly is the easy access accounts, maybe regular savers as well. They're the ones where I expect to see some increase, but not necessarily a massive increase. So keep an eye on that. Again, I've got my whole list of the best savings accounts, becleveryourcash.com/savings. I update that every single day with the best rates. So have a look and see what's there. At the time of recording this on the Thursday afternoon, Crew were offering 3.03%. That's a newish current account, KROO. That is the top rate you can get right now. Chip are planning to update their account to 3.04% on the 11th of February when they're making some changes to how that account works. I don't know whether they will stick at that rate or whether they might even try to increase it to reflect this increase as well. See what happens. I wouldn't be surprised if they just wait until this change on the 11th rather than do it straight away. But again, they're the ones at the moment trying to be top of the table. If any other banks below it try to push up and start getting there, they may decide to make an increase, or they might already have priced this in. Some of the increases we have seen recently, they've already calculated the fact that they expect this interest rate to come along, this increase to come along. They might already have passed this on. But again, we're looking around 3% for easy access. Where you're going to see potentially not much difference is around fixes. Maybe there'll be something going on, but the way a fixed savings account works is they look ahead. You're fixing for a year, 2 years, 3 years, 4 years, 5 years. There's a new one for 7 years that's just launched. They look ahead. They look at where economists and markets are predicting the rate to go and other things around the economy to go. And so when we had all that nightmare last October with the mini budget and Kwasi Kwarteng and Liz Truss, that whole thing meant, that whole nightmare meant that interest rates were predicted to maybe hit 6%. So the fixed rates were based on that back in sort of October time. When that changed, and the prediction was, as we have had for this announcement from the Bank of England and the last one, looking at a peak of around 4.5%, that's meant that, well, actually, those fixes have started to reduce and they've been going down. I update my list, I say, every single day, and particularly the 1 year fix, every day, if not every other day, dropping. The best one, 4.17% for a 1 year fix, compared to 4.65 you could have got last October. Now, I would not expect, can't guarantee it, you might find one or two providers do decide to do something and that might spark a little bit of a kind of a competition war. People want to be top of the table. I wouldn't be surprised to see much of this increase happening on fixes right now. So really, if you want to fix, don't think there's any harm doing it right now. If anything, they might continue to drop based on the analysis from the Bank of England. That's savings. So good news, easy access. Some of them will continue to go up. Fixes, not so great news, probably stay where they are or continue to drop. Let's talk about borrowing. Some credit card providers may well increase the rate of interest on your credit cards. Ideally, though, you are not going to be using, when you use a credit card, you're not going to be getting charged interest. You pay off that balance every single month in full. And when I talk about credit cards here on the channel, it's about the rewards and the benefits you get from them rather than a way to just pay for the essentials. If you are struggling to cover costs, everything is still so expensive and inflation is still very, very high, then you will potentially be wanting to look at other alternatives rather than credit cards. See if you can get help if you are finding that all those costs are too much for you and you don't put your head in the sand. Don't just borrow and just hopefully you'll get around to it. See what you can do to try and sort that out at source. So again, credit cards could get more expensive, loans could get more expensive, but I would encourage you to look elsewhere if you're looking at them as ways just to get by. In terms of mortgages, though, this is the big one, and this is far more complicated, right? So I'm not going to be able to give you an answer to this one if your mortgage is about to come to an end. I can tell you what is going to happen to some mortgages based on this increase. So if you have what's called a tracker mortgage, a rate that follows the Bank of England base rate, they will go up almost immediately by that 0.5 percentage points. So let's say your mortgage right now is the base rate plus 2%. It will go from 5.5% to 6%. You will be paying that almost immediately. If you're on a variable rate deal, then it's likely that much of that increase, if not all of it, will also be passed on to you. Maybe not straight away, but they can change that rate at any time, and they're often some of the most expensive rates. So again, you'll start paying more now. If you're on a fixed deal, nothing will happen right now. You'll continue to pay what your monthly payments are based on what you fixed at. The problem is when that fix ends, when you come out of that, you'll be going into a market where rates are very, 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 very different to where they were when you probably took that fix because of all the massive increases you've had over the last year and a bit, plus that nightmare we had back last October. The problem you've got here, normally I'd say, well, you want to fix before an increase, particularly if we're getting more increases coming on the way because they're just going to get worse and worse. And you can often lock into a mortgage deal 3 to 6 months in advance, either with a different provider or with your existing provider possibly as well. Where we are now, the problem you've got is maybe there won't be any more or not too many more increases coming along. And also some of those sort of fixed rates have been falling because they went up to that stupidly high rates last October time. So it's very, very hard to say whether you should be, if your mortgage does finish in the next sort of few months, next 6 months, whether you should be getting tied in now. Not necessarily a bad thing if you can, there's no charges for you to getting out of that deal. But I would personally be talking to a mortgage advisor here, get their sense of what they think is happening with the markets, whether you should be locking in or not. If you are on a variable rate, again, talk to a mortgage advisor whether they think you should stick around there, or maybe you might want to see how things go. Similarly with a tracker deal, even if they are more expensive than elsewhere, it might be worth just going on those for a while in case rates do start to fall down, or at least the mortgage rates start to fall, and then fixing. Again, lots for you to think about there. I don't envy your position if that's something you're having to deal with right now. My name is Andy Webb. Thank you so much for watching. Make sure you check out these videos here for more on your savings and your mortgages.